Joining me now is Jeffrey Small, president of Arbor Financial. It's a financial investment management company. Jeffrey, thanks for coming on the show. So fractional gains, the Dow, the NASDAQ up 0.6%, the S&P up 0.7%. What's behind the strength that we've seen these past 2 days in the market?
Well, a little bit more weakness in the dollar, and of course, yields are falling, and that seems to be the correlation driving market prices in this very excessive global inflationary environment that we're in. But you'll notice on the up days, we see the Treasury, the 10-year note dropping, and the dollar getting weaker, and the buyers coming back into the market. But on the down days, we see rates rising, and so we're probably going to retest 3.5% on the 10-year before the end of this month. That means there's more volatility on deck until we see what the Fed does next month in anticipation. But inflation, have no doubt, is a global issue. It's not specific to the United States of America.
Right. Well, let's talk about that because the European Central Bank raising rates for the first time in years today, even 2.5 years into this pandemic. And I do believe one of the latest reads on inflation out of the UK was that inflation was rising at its fastest clip on record. So these actions by the ECB coupled with what we see from the Fed, what does that mean for risk assets in general?
Generally, the risk is skewed to the upside in this type of an environment where the global central banks in concert are raising rates to combat inflation. But what everybody seems to forget is inflation can still run rampant regardless of what the central banks do because they can't control supply chains, they can't control energy, and they can't control food costs. And those are the three dynamics as the Eurozone just set a record for the 8th straight month, 9.1% inflation rate, which is unbelievable considering, like you said, what they've done to rates. Since 2014, they've been negative.
Yeah. Okay, so are you in the camp, Jeffrey, that the Fed, the central bank here in America, will be raising rates by 75 basis points or 0.75 percentage point at this next meeting and decision date comes September 21st?
Well, there is some economic data that might give them a little bit of leeway where we could see 50 basis points instead of 0.75. But I think Powell is pretty steadfast in his decision to try and squash this inflation. I see them going up another 75 basis points. But I think for the most part, that's priced into the market at this stage. The real problem becomes what's more important than the Fed today is what the next CPI report is going to show. And if that CPI report is moderating to the south side of the equation like it has been, dropping that is, then that will be a signal for the markets to maybe have a short-term rally and maybe see a 50 basis point rise, depending upon how far it drops. So if we see something under 6%, that would be the best news we could hear.
So what is your expectation? I do believe that inflation report is on deck for consumer prices next week, Jeffrey. How much do you think they're going to rise by?
Wow, that's a great question. I definitely know they're going to go below where they were in the prior report. I don't know how much. I think we keep trending down. I think the Fed has maybe 2 or 3 more rate increases left, and then they're done without truly crushing the economy. As we see, the housing market is now officially in a hard recession. That's going to get worse as mortgage rates continue to climb, and there's less activity. That's 1/5 of the economy. The other 4/5 of the economy, of course, are doing well. Labor participation rate is great, and there's lots of reasons to be long in this market as we could potentially see a bottom to the market by December of this year.
So you don't think we've actually hit a bottom? Is that right? You think we could actually fall beneath those mid-June lows?
I think there's a really good chance if we look at the historical averages, despite this being a midterm election year, unless the Congress goes red in the fall, and I'm being apolitical here, if they go red, I predict we will have a rally.
Why is that?
Well, I don't think we'll see any more policies that are economically destabilizing to the economy, and raising taxes in a recessionary and the highest 50-year inflation environment made absolutely no political sense as it stoked the fires of inflation. On top of that, this new Inflation Reduction Act really wasn't an Inflation Reduction Act.
Yeah.
That was code word or doublespeak for let's get something passed and pretend it's going to do something for inflation. But all it really did was aggravate the problem even further and brought no relief to the average American who's suffering the greatest at the cost of this inflation and high energy prices, which fortunately have moderated down recently.
Certainly was an interesting choice of words, what to call that particular act. And we've seen actually more inflationary pressures enter the market too. Of course, massive student loan forgiveness impacting more than 40 million Americans. Jeffrey, wiping away that debt, adding free money to the system as well, even though, of course, for many people, it will be a positive for their financial picture. I'm just curious, given the factors that we're discussing here, at what point do you think inflation can return to the Fed's 2% long-term target?
The inflationary component is not going to return to 2%, probably at the earliest till mid-year next year, 2023. Once we see inventory start to rise and things like vehicles and real estate and intangibles that we buy at the stores, once we see the pressure off, but that's going to be really hard to press when everybody's got a job. Everyone's got a job right now. Labor force participation is going up. Unemployment ticked up a little bit. Earnings forecasts are going to be 2% less next year than they were this year. And so the economy is technically on fire. You could consider it a Goldilocks economy if interest rates were in line, but rates have to be, of course, increased to quell inflation. Things are out of control.
What do you think this means for the jobs market? And I ask because, of course, everyone needs and wants to support themselves and their families, but especially so heading into the holiday period, right? What does this mean? Can the labor market hold up despite higher rates?
I think the labor market is going to be fine. I don't think we're going to see plans for hiring like we've seen. And most major corporations have decided to cut their hiring plans down significantly, with a few announcing layoffs from upper management all the way down to the rank and file. And so for now, though, it hasn't really impacted the numbers, even though we saw a slight uptick in unemployment from the last employment report.
Jeffrey, are there certain sectors of the stock market that you like, that you would recommend that your clients or investors buy into right now, and perhaps other sectors that you would stay away from?
Well, I think the investment cohort that does the best in this type of environment are value stocks. Stocks that have a really good dividend, let's say between 3 and 5%, that are underbought, underweight to the price to earnings multiples of the market, and that have brand names with good balance sheets and great management and the ability to grow. That's a Buffettism. Okay, we've all heard that. But that cohort of investments is only down about 4% this year to date. So it's outperformed the market by 12 points. And so the other thing that we can look at besides value stocks are tech plays that have been beaten up. I don't think you get a chance to own Disney or Meta or Apple at these prices ever again after this year.
Interesting. So for tech names in general, Jeffrey, I know you were mentioning a few there, but what about the tech sector as a whole? Do you think people can buy into the technology sector as a whole, or would you caution against that?
I would be very selective about what they pick in tech. I would highly recommend they avoid chips. Chips are under great duress right now. With the chip market is kind of crazy in terms of the United States withholding chip productions being sent over to China. NVIDIA recently took a big hit. I've heard a lot of pundits on the major networks talk about buying NVIDIA. I think NVIDIA is stock is overvalued. Don't buy NVIDIA. If you own it, you probably want to get out of it. There's going to be more duress. They're going to take a $400 million hit next year from the suspension of chip sales to China. And all we did with those chip suspensions is embolden Chinese competitors to fill the gap. And I don't understand why we keep robbing Peter to pay Paul in these environments, but that's the current policies that we have. So chips, no. Technology in Google, Apple, Facebook, Meta, Disney, those types of things you want to own going forward. They've been too beaten up.
All right, Jeffrey Small, president of Arbor Financial. Jeffrey, thanks so much for coming on again in another day with a rally for the stock market.